A very good morning, listeners. This is Almus Market Mornings, your space for global financial update with Shikhar Garg. And it's the last trading day of the week with a very few updates on the domestic side. India's unemployment rate dipped to 7.2% in an NSO survey for the quarter ending this September, while it was 9.8% a year ago. On the trade side, our chief economic advisor was found cautioning about the growth concerns for exports, majorly on the backdrop of global economic performance concerns. Oil continues its volatile period as the G7 and rest of the nations continue to talk about the possible price caps and the supply increases, if there's any, which was denied by the OPEC. On the Euro front, ECB Vice President Mr. Lewis mentioned we are near peak inflation for the Eurozone, with the inflation continuing to hover around these levels for a few months. So, JK, is this the kind of trend that we are setting in with the inflation, hovering around higher levels for a few months, even if not, going any higher? What's your take?
Yeah, Shikhar, good morning. In fact, the ECB speak has been quite variant from various members speaking slightly different languages. We had few members saying that rates are far from peaking, inflation is still high, and some members hinting at possible impact on the economy. I think we look more at the ECB minutes, which came close on the heels of FOMC minutes, and they showed that very much like the Fed, there is no indication of a pivot, but there are hints about concerns on recession for the economy going ahead. In the absence of US markets being there were hardly any movement as far as the stocks and the yields are concerned, and Asia market were much more active, led by the Malaysian equities, which rose strongly, and the Malaysian ringgit, which strengthened after the political changes there. Now, basically, investors are now looking ahead to meetings of central banks of major countries: Canada, UK, Europe, Switzerland, and Japan next month. Of course, Fed is also there on the 14th. But barring Japan, who is the odd man out in this phase of global inflation by holding on to easy policy, rest of them are again expected to indulge in hefty rate hike. Both the ECB and Bank of England are expected to hike by 0.5%. And after a hefty 0.75 hike by our Reserve Bank of New Zealand on Wednesday, yesterday we saw Sweden raise policy rate by 0.75, and EM central banks, South Korea and South Africa, raised policy rates by 0.25 and 0.75% respectively. What's more, they also indicated more hikes coming. So it's not all done as far as the hefty rate hikes are concerned, while Fed is actually indicating a slow pace of rate hikes. And also contrast this with what we have been mentioning in our daily report, some of the data from Europe and UK already looking better in terms of the economic news, and encouraging for the central banks to go in for on inflation control further. US data, on the other hand, has been quite tepid. The latest indications coming from the weekly jobless claims and the PMI survey, which showed manufacturing slipping into contraction and the services sliding further. So the latest AFO from Germany actually showed index rising more than what economists had expected, with companies turning less pessimistic about the economic activity or outlook. This is a narrative of less pessimism, but it definitely not an economic collapse, as some had predicted for some time. The yield curve in Germany, of course, has steepened to minus 13 basis points, which is the widest since 1993. The positive impact of softer US data with implications on monetary policies have been felt in the stocks and bond markets in the rest of the world. Overall, with the comprehensive index of global stocks moving up by 0.5% yesterday, but it has had a 3% rise in the last 3 days. And we are looking forward to the next week's jobs data from the US. Indications perhaps not so good that, so many layoffs reported by big tech companies, and also the weekly jobless claims coming weaker, rather becoming higher, indicates that the jobs report may not be as strong as we have been seeing for several months now, and then which will also be preceded by the PCE core inflation. Very strong or a very big week ahead as far as the economic news is concerned. On the currency side, euro traded a high of 1.0444, although it has retraced somewhat since then. GBP hit a high of 1.2150, and the New Zealand dollar also pushed up to a 3-month high, reaching under 6290 in London close. In fact, Aussie dollar, which normally tracks the yuan and gets influenced more by it, also pushed ahead yesterday, gaining almost 3% this week. While the currencies do look to have seen their worst in this cycle, near term there may be some retracement, particularly after touching important 200 EMA for many of them. Yuan is a stock underperformer. Recent spike in infections is a real test for the Chinese leaders, who have recently signaled a higher degree of tolerance in order to minimize the economic impact from lockdowns. But speed of the rise of infections may force them to change their mind. That's the one thing that the entire market is looking forward to, and their decision may actually decide how the risk sentiment goes ahead. Going ahead, deliberations of to use the proposed oil cap for Russian oil continues, with Poland rejecting the EU's proposed $65 per barrel as being too soft, while Greece, a massive player in the oil shipping industry, does not want to go below 70. So the huge differences are rising there, although December 5th is the deadline when the oil price cap needs to be implemented. That is also the time when the European ban on Russian oil import takes effect. So there's quite a bit of volatility in store for oil prices. That may keep the oil importing countries somewhat on their edge. Rupee did show some marginal strength yesterday, as some of the Asian currencies led by Malaysian ringgit were stronger, but still the USD was supported against INR on dip. While the Indian stock market BSC, the Bombay Stock Exchange, hit an all-time high yesterday, INR is trading not far from its historic low, which shows how much the two are disconnected, and also how much the domestic investors are more influenced in the stocks. However, a weak dollar index, which is rarely accompanied by a weak oil price, may be a help to the rupee to show some strength in the session ahead. Thank you.
Okay, quite good, JK. And folks, yes, yesterday was the day Bombay Stock Exchange index traded an all-time high for the Indian markets, and this is something many folks have been waiting for. But just as JK mentioned, the disconnect between the currency and index is quite strong, as we are trading around the all-time high for the index. We are not particularly any stronger in the currency. Although there's a lot of layoff trends continuing in the global markets across, with tech leading the race in the case of layoffs, there's the concerns on the economic performance continued across the globe, with BOE, ECB, everyone continuing to mention the likely recessionary phase already on its path. And what shall we say about the kind of rate hikes that we are seeing? I mean, it's almost everywhere, and this kind of synchronized action with the central banks is quite interesting to watch as to how inflation would be seen in coming days. But all said and done, it was the day for Malaysian markets, as yesterday Malaysian markets rejoiced and sort of enjoyed or was really confident about the change at the top, and that's why the stock markets rallied, and it also had some effect on the other Asian markets. That's it for today, folks. Have a good weekend, and we shall come back again on Monday with another round of fresh updates. That's it. Thank you.